You were told the bank is a vault, a place where your money sleeps safely, waiting for you to wake it up. That is a consensus hallucination, carefully maintained for over a century. The legal reality is far colder. The moment your paycheck clears, you stop being someone storing cash inside a vault and become an unsecured creditor to a highly leveraged institution. The bank does not place your dollars in a box with your name on it. It owes you that money, while using most of those deposits to fund loans and other investments throughout the financial system. In 2008, that machine seized up. The world watched as taxpayer bailouts plugged the hole. But what almost no one noticed was the quiet rewrite of the rulebook that followed. Today, many countries also have legal frameworks that allow failing banks to be stabilized through bail-ins under certain circumstances, and your deposits can become part of that conversation. To understand the trap, you have to go back to the precise moment the narrative snapped. It was the G20 summit in 2009 when global regulators declared an end to the era of too big to fail. The public heard no more bailouts. The banking industry heard something different. Build new ways to keep banks operating without relying entirely on taxpayer money. One of those mechanisms became known as the bail-in. In a bailout, governments inject public money into the financial system to stabilize failing banks. In a bail-in, regulators can require certain investors and creditors of a failing bank to absorb losses instead. Depending on the country and the situation, that can include some uninsured deposits. This is not a fringe conspiracy. The legal frameworks exist. Similar resolution powers were built into the Dodd-Frank Act in the United States and into the European Union's Bank Recovery and Resolution Directive. The concept was tested during the Cyprus banking crisis in 2013, when many large uninsured depositors woke up to find part of their savings converted into bank capital. The blueprint already exists. Whether it is used again depends entirely on the crisis. The mechanics are a surgical extraction. Every bank follows a legal hierarchy when absorbing losses. Shareholders lose first. Certain bondholders are next. If the losses become severe enough, regulators can require other creditors to absorb part of the damage as well. In some situations and jurisdictions, that can include large uninsured deposits. The goal is to keep the bank functioning without immediately collapsing into bankruptcy. These decisions can happen over a single weekend, while regulators work to prevent panic from spreading across the financial system. Meanwhile, many institutions that provide short-term funding to banks often receive special protections because governments fear a wider financial chain reaction. The ordinary depositor assumes their money is simply sitting in an account. Legally, it is part of a much more complicated financial structure. For American viewers, this overlaps with another silent drain. Inflation is almost like a slow-motion bail-in. The dollars sitting in your account may keep the same number on the screen, but every year they often buy a little less. At the same time, America's national debt continues climbing, while interest payments consume an ever larger share of government spending. The Federal Reserve constantly walks a tightrope between controlling inflation and avoiding unnecessary financial stress. No matter which direction policy moves, your purchasing power can slowly erode. Even if a formal bail-in never happens, inflation quietly transfers wealth away from cash holders. The system isn't necessarily collapsing, it is constantly redistributing value through both legal rules and monetary policy. The macroeconomic reality check is this: bail-ins are not evidence that the system is broken. They are one of the tools built into the modern financial system to manage bank failures while trying to avoid wider economic collapse. The reason most people never think about them is because the system projects an illusion of permanence. The ATM still works, the banking app still loads, your balance still appears on the screen every morning. Confidence keeps the entire machine running, but confidence is also one of the banking system's most valuable assets. If another major credit crisis arrives, perhaps driven by commercial real estate losses, sovereign debt problems, or something nobody sees today, those legal resolution tools could suddenly become far more important than most people realize. That doesn't mean panic, it means understanding how the system actually works. Diversify. Don't rely on a single institution. Understand deposit insurance where you live. Consider keeping part of your wealth in assets that don't depend entirely on the banking system. Because the dollars in your account aren't sitting in a vault with your name on them. They're a promise from the bank, and every financial promise depends on the strength of the institution making it.